Hey business warriors, welcome back to the channel, and today we are going to tell you why hiring a financial advisor could be like flushing money down the toilet. Now, of course, this won't apply to everyone, as some people have their own unique situations, and there are some cases where it makes sense to hire a financial professional. We'll talk about those later, but for the overwhelming majority of people, especially if you are under 50, it often makes little to no sense at all. But first of all, let's discuss the different types of job titles, because financial professional is just an umbrella term for a variety of different jobs. So let's go through them all from the most shady to the least. Number 1, the stockbroker. Ah yes, I bet the idea of a stockbroker conjures up images of the Wolf of Wall Street. Shady men living a lavish lifestyle with private jets, fine wines, jacuzzis on a beachfront property. They must all be making boatloads of money. But according to payscale.com, the average stockbroker makes a whopping $58,000. Yes, you heard that correctly. Stockbrokers are often more broke or broke-er than you. Brokers are no more than salespeople selling stocks. So why is the image that they conjure up so different? Well, the higher paid brokers all work in investment banks where they sell large amounts of securities to other financial institutions. But the average broker selling to retail investors is often making under 6 figures. The reason they have a bad reputation is because some brokers are just unloading overpriced securities while others are churning your account, which means they're excessively buying and selling a security to generate more commissions for themselves without actually benefiting the customer. Now, churning is illegal, but many brokers get away with it because there is no quantifiable way to measure it. At any rate, as we've said on this channel before, the S&P 500 normally outperforms most actively managed portfolios, and it is no different with stockbrokers. Number 2, the full service broker. Full service brokers mainly advise and manage your investments whilst utilizing tax-advantaged investment vehicles, such as 529 plans, 401ks, Roth IRAs, traditional IRAs, and HSAs. In addition to investment management, they also provide other services such as retirement planning and estate planning. So let's say you've been working for 33 years now and you have $650,000 in investable assets. They will gather information about your current age, your kids' age, your income, expenses, and how many years are left on the mortgage, etc., and say, we think it is safe for you to retire at age 65 as long as you keep your spending to X amount of dollars per month and you don't buy a new car more than once a decade. Actual results may vary. Now, while you may think that this all sounds great, and you might be saying, when I turn 55, I'm going to turn to a full-service broker to make sure my retirement money outlives me, not so fast. This advice is not anywhere near free. While some stockbrokers do not charge an annual fee and only make money off trading, some firms can charge about 1 to 2% a year on that retirement account. While that might not sound like much, these fees slowly cut into your gains. 1.5% of $650,000 is almost $10,000 a year, and this is quite common. But let's say you're smarter than the average person because you've subscribed to the Business Shifu channel, and with shopping around you find a broker that only charges 1.25 points. You're still paying $8,125 per year. Not to mention, if the market goes down 10%, you've just lost $65,000 from the portfolio, and the advisor still collects his 1.25% fee, giving you a whopping return of negative $73,125. But wait, there's more. According to Investopedia, full-service brokers get paid on average $150 per transaction. So let's say you've got 6 different stock ETFs in your portfolio and your broker is managing them, and you're getting older and the broker wants to rebalance your investments by moving some of that money from stock ETFs to 2 bond ETFs. So he sells a portion of all 6 of those stock ETFs, and with that money he purchases 2 bond ETFs. That's 8 transactions. 8 times 150 is $1,200. That is absolutely ridiculous. I can go to my discount broker, Webull, and buy and sell as many times as I want, absolutely free. Speaking of Webull, if you haven't opened an account and got your 2 free stocks from Webull yet, consider doing that. Link below. So you can see there might be an incentive here to churn your account. Is it worth around $10,000 a year in fees alone? Our verdict is no! No! And to add insult to injury, these full-service brokers are only required to meet loosely defined suitability requirements for the investments. As long as the investments are deemed suitable, they will not be held legally liable for taking advantage of their customers through high commission products. So when looking for a financial advisor, we recommend that you search for a fiduciary. More on that in a moment. Number 3, fee-only investment advisors. Like full-service brokers who charge a 1 to 2% annual fee, these fee-only investment advisors are the same, but they do not get paid commissions for trading, so there is no incentive for them to churn your account. Generally speaking, the financial advisor is engaged in a win-win relationship with you because the higher your account balance goes, the more money they make. So if he charges 1.25% of your total assets and you've invested $500,000, the advisor will collect $6,250 that year. But if he grows your account up to $1 million, assuming he's charging the same fee, he'll make $12,500. But generally speaking, the more money you have invested, the lower the fee, so he might be getting 1% at $1 million, which adds up to a gross figure of $10,000. Get it? Gross? But again, why pay all that money when you could just buy an S&P 500 ETF all by yourself? The majority of active fund managers underperform the S&P 500 over the long term, so you'll be paying all of those fees and underperforming the market on top of that. And don't forget, the manager is probably buying mutual funds and ETFs within your account, which charge a fee as well. So everyone is getting a cut off of your investments whilst you're taking all the risk. Number 4, robo advisors. This type of non-human advisor has become popular recently due to lower fees. Robo-advisors charge only 0.25% a year. So for a $500,000 portfolio, you're looking at only $1,250 a year versus $6,250. Some would say that the convenience that robo-advisors offer, where you can just set it and forget it, is worth that quarter point in fees. Robo-advisors will take care of rebalancing your portfolio and making monthly additions. So in the settings, you can program them to take a few $100s out of your paycheck each month so that you don't have to. But if you've studied just a little bit about money management, which I'm sure you have because you're watching this channel, you'll realize that it really isn't that hard, and many discount brokerages also have a function to take money out of your bank account automatically each month. With just a little bit of 5th grade arithmetic, I think you can manage to rebalance and add some money to your account on a monthly basis. Number 5, fiduciary financial planners. This type of financial planner doesn't just sell you stocks and investment products, they also have a legal requirement to put the customer's interests before their own. So to give you an example, you and your fiduciary financial planner have determined that purchasing life insurance is in your best interest. There's 2 different policies that are suitable for you, and the fiduciary has to pick one. Insurance A pays the financial planner a commission of $4,000, and Insurance B pays a commission of only $1,000. But Insurance B is just that little bit better for you. Let's say hypothetically it's $1 better for you. Well, that fiduciary is obligated by law to sell you Insurance B. While some brokers and insurance agents make big bucks by selling you big ticket items, fiduciary financial planners make less money in the short term and more in the long term by cultivating long-term stable relationships with their clients. But just like a full-service broker, they charge a 1 to 2% fee, and generally there's also a $1,000 retainer each year, so you could be paying between $5,000 and $10,000 on a $500,000 portfolio. So are any of these options worth your money? Well, despite me talking about how much of a rip-off they might be worth it for some people. Let's take a look. First of all, I'd recommend an investment advisor for someone whose heart starts pounding as soon as the market goes down a little bit. If you need a voice of reason to talk you out of selling stocks at the first sign of a sell-off or buying stocks when the market is high, then a financial advisor might be for you. The second type of person is someone who just wants to set it and forget it and just can't be bothered to open up and look at their account. If this is you, a robo-advisor may be suitable for you. The third and last type of person who may need a financial advisor is a high net worth individual with a complex financial situation. If managing your finances is so overwhelming because you're the type of person that needs estate planning, trusts, life insurance, annuities, and you're setting aside college money for 3 kids while simultaneously running 3 businesses, you're probably too overwhelmed to look at money in your free time. Paying a financial planner that you meet with a few times a year could be worth it for this type of person. Otherwise, if you're not one of these type of people, why not subscribe to our channel to learn how to manage your finances yourself? We're gonna have loads of content on investing. Coming up, we've got a couple of videos how to cut down on your taxes with IRAs, both traditional and Roth IRAs, so do subscribe for that. If you want 2 free stocks for signing up for Webull and funding your account, link to that is below. We'll see you next time. Bye-bye.